Excuse me, what's cooking, Gumbo Nation? Welcome to this week's Humpday Holla, brought to you by Mortgage Gumbo. Hey, sorry, a few minutes late there. Had a closing this morning that ran a few minutes over. So we're getting started right now. And a lot happened last week, and I think we need to address, James, the severity of what happened, how did it happen, and now what is next when we are looking at things such as the 16th largest world in the bank going insolvent.
You said that backwards. 15th largest, 16th largest bank in the world. You said
Yeah,
world
I'm
in the
sorry.
bank. No big
Yeah,
deal.
my bad. You know what I'm saying. So what I want to discuss here is, and I think it's important for us to review, is this is scary. You and I dabble in this every day, but I think for the common listener and somebody who has money in a bank, they may not be realizing um, how we got here and exactly what happened. So I want to go through this. It's crazy to think of how it did happen, and we're going to share. I mean, we're going to uncover the second this got. And remember, I told us I said on Saturday, I want to look into this to kind of find out the whys. I mean, we are going to play a video or a soundbite on when this happened and what caused it and all that. So, how does the 16th largest bank go insolvent? So, before we get into that, and I've got my notes here because I want to make sure that we're factual. Because, folks, I need you, and that's why I'm even putting my glasses on here, because this is a big, big, big deal. A big, big deal. And I want folks to understand. And what we're looking at here is, before we get into the bank, let's talk about what the Fed's been up to. And unless you've been under a rock, you know that the Fed, since last March, has been hiking the federal funds rate at an absolute feverish pitch, to the point of where we had zero rates, 0%, to where we are now at 4.75, where we stand, before the Fed speaks next week. And we'll address that too. So, why have they been doing this? Why have they been so aggressive? Well, listen, the Fed, as we've discussed on Mortgage Gumbo, sat on the sidelines for a very, very long time. And they went from 0 to 100. Very, very aggressive, James. I mean, 0 literally to 100, with the Fed raising the rates.
And there's a case to be made for ripping the Band-Aid off and raising the rates quickly rather than slowly, and just getting all the convulsions out of the way and trying to return to normalcy. But the problem is, you don't have a Band-Aid on anymore. When you have ultra low rates for a decade, you now have built into the financial system all of these bonds that, I'm not going to say they're all worthless, because that's an exaggeration, but they're absolutely crushed, because all these bonds for a decade that were sold at 2% interest or whatever, they are all losers now. And bonds are supposed to be your backstop. Bonds
and you bring up a great point, and that's what we're going to talk about. So, if you and I and anybody listening would have performed the way Janet Yellen has, or Jerome Powell, we'd all be unemployed. Nobody would even accept our resumes. Yet these people continue to be in decision-making roles that affect all of us. So, what's the why? Why has the Fed gotten so aggressive? Well, the economy was moving fast. As James just alluded to, sitting at 0 for a long time, 2.5% mortgage rates. People were spending, values of homes going through the roof, right? Cars are now through the roof, right? So everything was going crazy. So they come in and they go, we've got to slow things down. And we talked about, their exact wording was, they had to create pain. And how do you do that? How does the federal government do that? Well, they've got to slow down spending, right? And they've got to try and reduce jobs. Okay. So to understand that, we've got to get into knowing how does a bank work, right? So, and we'll pull up a graphic in a second. Not yet, James, because I'm going to break it down. But let's face it, James, you know this, and for the listeners, for a bank to earn your business or your deposits, they have to pay you interest. We all get that, right? Their goal is to keep your money for as long as possible because they then use your money to make loans, HELOCs, ARMs, car loans, CDs, etc. Well, what's happened is because of these rapid rate hikes, they want to be able to pay you more interest. And some of us, you may even remember going to I can remember my parents going to the bank and coming home with our first microwave was because they went and did a deposit, right? Remember when the banks used to give you things to come give you their money? Well, as James alluded to, when rates are at zero, they can't really give you much. So then the proverbial free checking came around, right? Hey, we're going to give you free checking. And man, that sounded great. No fees, no this. Well, how can they charge you anything? They're not going to charge you to hold your money. Does that make sense, James?
Right. I mean, they would if they could get away with it.
Of course.
In some cases, they figure out how to fee you here and there. But no, that's not the way the traditional banking system has worked our entire lives.
That's right. So the banks want to give you more to get your deposits. So as the Fed starts to increase interest rates, well, now you'll see all of a sudden the banks are going, hey, 3.5% yield, right? And so the banks are trying to give you more money. Now, in a normal world, when you go look at a CD rate, the longer the bank holds your money, the more they pay you, right? So right now, because of the Fed being so aggressive, we have what's called an inverted yield curve. So what that means is 2% bonds, 2% treasuries are yielding more money. And when I say yield, returns, giving you more money than long-term 10-year treasuries, which is where bonds like to operate. They'll go buy that 10-year treasury. They use that as collateral to mix and move, right? So as the banks raise these rates so rapidly, the 2 years now paying higher than a 10-year. So if the bank went and invested $100 million in a 10-year treasury that's paying now 2%, and the 10 years paying 4%, well, that bank has lost money. It's worthless in today's market, right? So you ask how? How does that happen? And the how is this. Treasuries that have 2%, they're losing money when they're trying to be competitive and have to sell at 4%. Right? Am I explaining that correctly, James? Because I just want to make sure.
Well, the bond values are inverse to the interest rates. As interest rates go up, existing bond values go down.
So an easy way to put this where everybody will understand is there's no margin for profit. Right? Is that a good way to put it? So there's just no margin for profit when that happens. So the bank's value is much less, right? Their capital is affected when they go to try to borrow money. Okay? So, and that sort of is what leads us to SVB. But before we do that, let me kind of pull up that graphic because I want to show this illustration here of really how remedial it is, because I think it's important that people see just how remedial it is that how the banking system works. And when you look at this graph here, what this is basically showing you is, let's say you have $100,000 that you deposit. Well, the bank's required, they hold 10% of that, right? That's set aside for you. All their 10% is because if James decides to come in and get his money, they've got money in there, right? So the bank is trying to make money with the remaining 90,000, the other 90% of your money. So at a 0.5% on your 100,000, as this illustrates, what does the bank do, James? They give you $500 you made on a year. But on their 2% stock that they have on that 90,000, they made $1,800. So that's a net of $1,300. You got some interest, but they made $1,300. But imagine this on every single client a bank has, right? A $1,800 return, you go, hey, not bad. But imagine on every single client. Okay? So this leads us to SVB. And a couple terms I'm going to give you here. So if you're taking notes, right? And and it's funny because, Dodd-Frank, we've all heard of Dodd-Frank. Well, Frank, guess what? Barry Frank was also on the board of SVB when you start looking at this stuff. It's hilarious.
Barney,
right? Bob Frank, yeah. So then you look at not only that, one of the Fed chairmen on the board was on this board and it's been selling stock over the last 90 days. You also look back, and I'm just kind of going off on a tangent here. Then you look at the chief administrative officer was the guy that ran Lehman Brothers, James. Remember that dude? Like, how does he even get a job?
And to refresh memories out there, the reason why Lehman Brothers is putting a red flag in the back of your cerebellum is because that was the one big domino collapse that sort of started the 2008 financial crisis. Bear Stearns and Lehman Brothers. Yeah.
So when this all happened, Dodd-Frank comes up and they say, hey, we're going to allow banks to hold to maturity. So they buy certain bonds, and if they hold them to maturity, they don't have to show them as losses against their spreadsheet, right? Okay, so they don't have to suffer any kind of market losses because they're securitized because they're holding them to market, right? So looks good, sounds good, makes sense, right? And they don't count this against the bank's capital. And I'll explain more about that in a second. So when you do this, all right, it's called Tier 1 capital, right? So what is your Tier 1 capital kind of before? Kind of that everybody, kind of like that truck driver's got two sets of books, right? The one where he's blowing through those truck stops and the other one where he's stopping, right? So kind of got that. So the banks get stuck with these long-term loans, as mentioned above, right? So to make things even worse right now, you've got the Fed out offering short-term treasury bonds at 5% on 6 months right now. So here they're raising rates rapidly, and this is where just these folks are absolutely clueless, just clueless. And it's amazing that they sit in these positions that control everything. So they're offering 5% right now. So if you can trade and get a 5% in 6 months, why in the world are you going to do a 2-year, 3-year, 5-year CD? And how are the banks supposed to even operate at that, right? So
well, also, it's seeing as how the FDIC only covers up to $250,000, you're not going to leave that in a savings account or checking account unless you absolutely have to. And I know $250,000 is far beyond that of the average household, but we're talking about Silicon Valley. So what do you think Netflix checking account looks like? What do you think Facebook's checking
Roku,
account?
who was a big investor, the Motley Fool.
Yeah,
all these big folks. So what happens is when that happens, when James, you hear about somebody online going, hey, we're going to pay you 5% on a 6-month CD. Well, what happens, and this is where it's a little concerning, you go start taking your money out of Cap One, Chase, all these other little banks. So what does that happen? That hurts, right? It's almost like if I've got a higher mortgage rate than everybody else around me, people can like me all day long. They're not going to use you. People are always, loyalty is to your pocketbook, right? When it comes to that. So for 8 months, Silicon Valley Bank did not have a risk management officer. Can you imagine that? For 8 months, they didn't have anybody looking at their books going, what's going on? What's been happening over the last 8 months? Fed is skyrocketing federal funds rates, right? So Silicon Valley Bank had 80 billion, not million, billion in your Rokus and 2% coupons. So when we start talking about rate hikes this entire year, how they didn't see this coming, I don't know. But obviously people were asleep at the wheel, right? They were asleep at the wheel. So we talked about the chairman, all that stuff. So, and how the Lehman Brothers, you said, was part of the 08, 09 collapse. So even with all this said, all right, well, Dwayne, I still don't understand, how does this bank go under? So stick with us here. We've got about a little bit over a minute. This is what drew everybody's attention. And it shows you just how close, and this is scary, how close some of these banks may be. And then we'll finish up talking about some of this hold to market, and I'll explain that. Play this soundbite, James.
Yeah, I'd just like to say this is from February 8th, last month.
February 8th.
Jack in. The ninth best performer year to date is SVB Financial, don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year, they could come back. Yeah, some of them come back here with the stock directly affects an oversold position. Stock was the fourth worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. Now, you have to remember that a stock that falls 66% like SVB Financial did last year, it takes it a lot more to recover. After losing 2/3 of your value, you need a 200% gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run. Jack in.
So Mad Money draws light on this SVB, trying to tell them, oh, there's so much more upside. Look how poor it's doing, but get on in it. So what happens? Regulators, depositors, financial advisors, managers, stockholders, what do you think, James, they're advising when they hear him talking about that?
Yeah,
go get your money.
They should. To be fair, he's going over a whole list, and not all of those companies that he promoted on his show that day collapsed, but this one did, and that's a pretty big missed call. That's about like coming out and saying the Houston Texans are going to win the Super Bowl, and then they go 1-16 or whatever it was.
Right. So here Kramer sheds light on that. Now, I'm not saying that was because, but regulators, everybody starts looking at this. Well, when you start that, now all of a sudden they realize that although they've got 80 billion in 2% coupons, and they look like they have a balance sheet of 12 billion in assets, James. Well, when they all of a sudden start digging in, and remember I mentioned the hold to market, all those bonds that they weren't having, all those treasuries they were not having to count. Well, when they bring that in, all of a sudden they go from plus to minus 3 billion.
Yeah.
Now, you could say all day long, well, still on the Fed sheet, but nobody cared at that point, James. It does not matter. They could sit there still today and go, we got all these hold to markets that look at our spreadsheet. It's really not that. But when you look at the true books, James, when SVP had to sell $21 billion, they started having to short their stocks to sell it. Well, I'm not buying this when they're shorting it. They're calling James going, hey, you want to give us some money? You want to come make a deposit? Or are you going to make deposits right now? No. So when this $80 billion in coupons is called to market, it becomes a $15 billion loss, netting them minus $3 billion. So now there's blood in the water at this point, right? There's absolute blood in the water. FDIC insured, which is 250,000, all that stuff. Guess what? Only 7% of those deposits were insured, James. 93% of their deposits with SVB were not insured. And then you got Janet Yellen on Friday. The banking system is fine. On Sunday, saying there'll be absolutely no bailout. Well, guess what happens on Monday? The Fed comes in and says, we're going to buy your reduced underwater treasuries, do all that to make the depositors whole. Sounds good, right, James?
Not to me, but I understand.
So we don't want to get into conspiracy theories. We'll do that at another time on why, I don't want the Fed. I mean, nobody bailed me out when I lost money on Voyager a couple months back, right? You know what I mean? Nobody came to me and said, hey, we feel bad for you, right? So when you're looking at these things at some point, so here the Fed comes in, it's going to make these depositors whole. Okay, that's fine. So while they're saying it's not a bailout, it's a bailout. It's a bailout. And when the Fed gets involved, that we get into what I consider a danger zone. And then ironically, all of a sudden yesterday, Jerome Powell's being asked about centralized currency, this, that, and the other. So how does this affect mortgages? What does this have to do with mortgage rates? Okay, so right now, it gets people wondering what the heck's up with my money. It frightens folks a little bit. Everybody's worried about, I spent my Monday at my bank confirming that every account with the banks I'm with is secured, right? And they all won 200-something thousand, but I wanted confirmation, like to the point of what's your name? Not that, you go with the old, hey, what's your name? Let me get your name. Like that would matter, right? But, finding out. So there's alarm now. And as if there wasn't enough alarm when you're hitting back on 7% rates and everything that's going on, there's alarm. Now, we've been talking about the Fed, and we even been talking about these job numbers and all that and how it's affecting the market. And we've said, hey, we were looking at a quarter to 50 basis points next week, the Fed on the 21st and 22nd meet, right? So we're going to get some information then. My question now, what I think is going to happen is I can't see how the Fed with this raises rates again. So, and what I want to kind of back up on is for all of you listening to understand, data has a lag, right? So what the Fed is essentially doing is they're trying to just right wrongs. Imagine you're a patient, you're sick, you don't feel good. And you take medicine and you don't feel good in 5 minutes. So you take more medicine. And then you keep taking medicine until you overdose because you didn't feel better right away. That's sort of what the Fed has been doing over the last year. So I don't know what they're going to do next week. I think they're in a pickle. And what I think's probably going to happen here, James, is, and again, I don't know. I was on the raise it another 50 bips because they're using the jobs report, and their whole motto has been inflict pain, inflict pain, inflict pain. So now my thoughts are, is this the pivot that we were kind of talking about, James, that we've been telling folks maybe it's going to happen over the summer? Is this something now where they just stop for a second, take a pause, because every CEO, every chief financial officer, whether it's a bank, whether it's a mortgage lender, whether it's a servicer, all is in meetings this week, flying all around the country to go, all right, where are we at? Because
so you know what they're waiting on. You know what they're waiting on. All the banks right now are watching this because if bailouts are coming, then they don't need to adjust. If bailouts aren't coming, that means the rules of the game are changing and the politicians aren't going to come in and wipe their butts this time. And they will make changes accordingly. And don't worry, they will be just fine. A few of them will probably go out of business, but we were all predicting this when you had a decade of ultra low rates. The foundation of so many of these banks is built on these long-term treasury instruments that are now worth jack squat. Because either you are tying up that capital and it can't be touched until the end of the duration of the bond, which illiquidity, even though it's not showing up on the books, like, and that was perfect metaphor that, how the truckers keep two logs.
Yeah.
That's exactly what they're doing. And they're not counting these illiquid assets as losses. Oh, but they're losses, whether you count them or not. So the concern is that the Fed is in a no-win situation. And I don't feel sorry for them because they're the ones who put themselves there. But also the other issue that they have no control over is the deficit spending and the printing. And there's nothing they can do as long as we're going to run trillion-dollar deficits every year. That's going to have no negative effect. Someone's going to get screwed somewhere, and now their only job is directing which way the poo is going to be sprayed.
Well, and that's the whole thing, and that's where to kind of discuss what you and to bring back around what you said. If they bail out here, does it become the Wild Wild West? Because how after 08 can we, 13 years later, right? 14 years later, how in the world can we be having a bank collapse? That's all we've heard about is there's no shot. The banking system is stronger than ever. So this is a concern. So personally, for me, I don't want the bailout, James.
No.
Right? Folks,
God,
we
no.
do not want that because then we are giving up control. Then the banks can go bananas. And who's going to suffer? The big shots will be fine. The guy that was on the Fed board who sold all his stocks, you think he's hurting right now?
He's winning either way. Although we could send him into a retirement with his millions, or we could let him continue running this gravy train at taxpayer expense even further. Both of those are bad options for us.
That's right. So at the end of the day, I hope what James and I were able to kind of help you understand is this is frightening. Now, what I'm hoping for the real estate industry is we see some relief, maybe with mortgage rates, because if this slows down, again, I talked about it last week. Let's just call it the recession. Let's get the word out there so we can get on the other side of it, because we then know what happens then, right? When the inflation stops, mortgage rates will stop going up. Rates follow inflation, right? When the rates start to come down, the whole industry starts to work. People can then sell their homes. Right now, you've got a lot of people, James, at 2.5% to 4% interest rates who, whether they like it or not, they are stuck in their home, right? They're stuck. And some want to be, and I don't blame you with those rates. It's a good position to be in. But what if you wanted to get out? You can't, right?
That's a lot where I'm at, because if I went to try and buy a house of equal value or equal size right now, my payment would go up necessarily $300-400 a month.
Yep, absolutely. Absolutely. So stick around. Hey, the Fed's going to speak next week. We'll continue to research, get data. Our whole goal here at Mortgage Gumbo and using our format here, James and I, is just to keep you in the know. Everybody's seeing it. It's leading headlines, but what in the world happened? So just wanted to share with you, kind of share how the banking system works to try to give you as much education and knowledge as you can as we move forward with this, because we're all in this together. We're all at the mercy of the decision makers, right? And at some point, I'm going to have to stop scratching my head, James, going, how doesn't the Fed know this? And go, you know what? They know exactly what they're doing. And when that day happens, there's going to be pandemonium, and it's not going to be pretty. And the world's we're looking at a very serious danger zone. So let's just hope that doesn't happen anytime soon.
Do you want to squeeze in a quick look at rates?
Yeah, absolutely. We can real quick. Yep.
Who brings us Rate Watch?
So Rate Watch is brought to you by Tito's Handmade Vodka. It's America's first handcrafted vodka. So look, rates are sitting from Saturday. Nobody knows what's going on. Nobody understands. So 30-year 6.75, still off of the highs from 1 week ago at 703, right? 7%, 15,622, FHA 625, Jumbo 620, VA 626, and 5-1 arm 659. So, folks, again, like we talked about when we talk about the business side of things, ever to be considering purchasing or to be making moves in that direction. Because the closing this morning said, you know what? This is a temporary loan, but now we were able to getting our home because you showed us how to use less money. We were able to buy our home today that we thought we'd be buying 5 to 8 years from now. And that's what we're here to do for you. So, hey, till we see you on Saturday, Gumbo Nation, we love you. Go tell your friends about you. Follow us at Mortgage Gumbo on YouTube or any of our sites at The James Parker Show. Till Saturday, keep stirring the pot.